Think of someone who wakes up early every day, works hard, pays the bills, saves a little money, and even doing everything right, feels that financial progress is too slow. This feeling is more common than it seems, and Robert Kiyosaki has always drawn attention exactly to this point. He explains that wealth building looks nothing like a straight, predictable, or fair path in the short term. In many people's minds, each effort should generate an immediate reward. But money doesn't work that way. For a long time, you plant, water, and care without seeing anything bloom. It's at this moment that doubt, frustration, and the desire to give up arise. Kiyosaki often says that the mistake is expecting linear growth, when in reality, wealth grows cumulatively. Compound interest works in silence, almost hidden. At first, it seems weak, irrelevant, incapable of making a difference. The invested amount grows little, month after month, and this makes many people think it's not worth it. But behind this apparent slowness, something powerful is being built. Each small gain adds to the previous one, creating an increasingly solid base. It's like pushing a heavy car on a flat road. At first, it takes a lot of force and barely moves, but once it starts gaining speed, the effort decreases and the movement continues on its own. The big turnaround happens when the person understands that time is an ally, not an enemy. Those who accept this pace stop looking for shortcuts and start respecting the process. Instead of focusing on how much money hasn't grown yet, they begin to focus on the habit of continuing, even when the results aren't impressive yet. This is how compound interest does what it knows how to do best: transform patience into real, constant, and lasting growth. Many people believe that saving money works like a fair sequence. The first 100,000 requires effort, the next 100,000 requires the same effort, and so on. But this logic, despite seeming intuitive, is simply false. Robert Kiyosaki always explained that the beginning of the financial journey is disproportionately more difficult. The first $100,000 seems like a mountain. The first $200,000 seems like an almost impossible challenge. And reaching $300,000 requires something he calls financial brute force. It's not glamour, it's not luck, it's not extraordinary intelligence, it's consistent work, rigid control of expenses, and the ability to say no to many distractions that appear along the way. At this initial stage, money doesn't work for you yet. The one doing all the work is you. Each dollar saved comes from your direct effort, from the time you exchange for income, from overtime, from simpler choices like not spending on things that bring immediate pleasure, but no return in the future. That's why this phase is so tiring. It seems unfair to see other people spending, traveling, and living as if money were infinite, while you're counting pennies and being disciplined. But it's exactly there that most people give up, because they don't understand that this sacrifice is not permanent. It's strategic. The first $300,000 functions as the foundation of a house. Nobody praises a foundation, nobody applauds when it's finished. But without it, the house never stands. This phase requires emotional resistance, focus, and the maturity to accept that, for a while, financial life will be less comfortable than it could be. Those who manage to get through this period create something that few people have: a foundation solid enough to allow money later to start working on its own. Before continuing, let me ask you a sincere question. If everything being said here seems to describe exactly the phase of financial life you're living now, if you feel that you work, make an effort, save, but still don't see clear results, then this video is speaking directly to you. And if that's your case, like this video now. This simple gesture shows the algorithm, but especially yourself, that this message makes sense, that you're paying attention, and that you've decided to continue to the end of this story. There is an almost imperceptible moment in the financial journey, but one that changes everything. Up to a certain point, all growth depends exclusively on your direct effort. You work, save, invest, and money grows slowly. But upon reaching something around $300,000, something different starts to happen. For the first time, the capital begins to generate a value that can no longer be ignored. With an average return of 8% per year, this amount starts producing about $24,000 per year. It's not a fortune, but it's a clear sign that the game has changed. This is the turning point that few people reach, precisely because many give up before. From here, money begins to ease the weight that was previously all on your shoulders. It's still you who decides, who plans, and who maintains discipline, but now there's silent help. Capital starts working even while you sleep, while you're busy with other areas of life. This annual return doesn't come from overtime, nor from more immediate sacrifices, but from the time and consistency you respected back then. The most important thing is to understand that, at this stage, haste becomes the enemy. Small interferences, impulsive decisions, or attempts to artificially accelerate the process can break this flow. Those who get here need to learn a new skill: knowing not to interfere, staying the course, allowing compound interest to do what it knows how to do, and resisting the temptation to meddle too much. This is the moment when wealth building stops being just effort and starts becoming strategy. One of the most silent and dangerous traps in wealth building appears precisely when things start to improve. Income increases a bit, investments begin to show results, and without realizing it, the standard of living rises along with it. Robert Kiyosaki always warned that this is a classic mistake: spending money before it has time to grow. At first, it seems harmless. A better car, a bigger house, more comfort, more small daily rewards. The problem is that each increase in lifestyle creates a new, permanent obligation, while capital is still fragile. This trap works like eating the seed before planting. The person feels they deserve it. After all, they worked hard, made sacrifices, and now want to enjoy. And yes, enjoying is important, but the timing is decisive. When you consume everything you earn as soon as you start earning more, you prevent money from taking root. Compound interest needs space and time. If every extra gain is immediately transformed into spending, growth goes back to depending only on personal effort, as if you were always starting from scratch. The most dangerous thing is that the increase in standard of living rarely happens all at once. It comes gradually, almost invisible. One more service here, a subscription there, a habit that becomes routine. When the person realizes it, they're stuck at a level of expenses that requires working more, taking more risks, or giving up investing. Future freedom is exchanged for immediate comfort. Those who understand this learn to keep their standard of living controlled, even when income grows, until money is strong enough to sustain this comfort without effort. When the person starts to understand that getting rich takes time, a dangerous temptation arises, trying to shorten the path. It's at this point that promises of quick money appear, unmissable opportunities, stories of someone who got rich overnight. Robert Kiyosaki always explained that this trap seduces precisely those who have already made an effort, but haven't yet reached the turning point. The thinking is simple: if I've already walked this far, maybe a bold move will solve everything. The problem is that, most of the time, this bold move destroys years of progress. Speculation usually comes disguised as intelligence. Trendy stocks, promising cryptocurrencies, deals that seem too certain to go wrong. At first, it even works for a few, which reinforces the illusion. But what almost nobody tells is about the many who lose not only money, but also time, confidence, and discipline. Unlike patient investment, speculation puts capital at permanent risk. One big mistake can erase everything that was built with brute effort over years. The cruelest thing about this trap is that it interrupts the effect of compound interest. When you lose capital, you don't just lose the value itself, you lose everything that money could have generated over time. You go back several spaces in the game, sometimes to the beginning. Those who build wealth consistently learn to be suspicious of shortcuts. They understand that the true path may be slow, but it's predictable, and in the long run, predictability beats emotion almost always. After some time investing, many people start to believe they've already understood how the market works. They see news, follow charts, listen to opinions, and start thinking they can guess when the best time to enter or exit is. Robert Kiyosaki always warned that this excessive confidence comes at a high price. Trying to sell everything at the top and buy back at the bottom seems smart in theory, but in practice, almost nobody can do this consistently. And each wrong attempt breaks the rhythm of wealth building. Every time someone sells and buys back, they interrupt the most important process of all: compound interest. Money stops working while the person waits for the perfect moment. In addition, taxes, fees, and emotional decisions come into play. Fear makes them sell too early, greed makes them buy too late. In the end, what seemed like a sophisticated strategy turns into a cycle of stress and lower returns. The patient investor understands that the market is unpredictable in the short term, but tends to grow in the long term. Instead of trying to get every move right, they focus on staying in the game. Let time do the heavy work. Those who try to control everything end up sabotaging their own result. Those who accept that they don't need to be perfect, just consistent, reap the fruits of discipline and permanence. Envy rarely appears as something ugly or explicit. In financial life, it usually emerges subtly, almost disguised as motivation. You look at someone who earns more, who lives better, who seems to have gone further, and start comparing yourself. Robert Kiyosaki always explained that this type of comparison is one of the biggest causes of poor financial decisions. Instead of following their own pace, the person starts running a race that isn't theirs. This trap pushes many people into unnecessary spending, buying things they don't need, taking on debts that don't make sense, or to maintain an appearance, or to not feel behind. The problem is that while you try to keep up with someone else's standard of living, you sacrifice your own financial future. Each decision made by comparison weakens the capital that is still being built. The only healthy comparison is you today against you in the past. Those who learn this stop spending energy trying to impress and start investing in real progress. Money grows when there is path clarity. Envy confuses, accelerates wrong decisions, and breaks discipline. Those who build wealth solidly learn to walk in silence, respecting their own time and their own process. In moments of uncertainty, many people believe that the safest attitude is to do nothing. Keep money in cash, wait for the right moment. Observe from afar. At first glance, this seems prudent. Robert Kiyosaki always explained that this type of silent pessimism is dangerous, precisely because it seems rational. The problem is that time doesn't stop. While the person waits, inflation acts every day, reducing the purchasing power of idle money. The fear of losing makes many lose something even more valuable: time. And time is the main ingredient of compound interest. Each year out of the market is a year in which money stopped growing. Even small amounts, when invested with consistency, gain strength over time. Always staying on the sidelines, waiting for perfect conditions, means giving up this continuous growth. Those who build wealth understand that the market never seems totally safe. There is always some crisis, some bad news, some reason to postpone. The difference is in acting despite discomfort, with strategy and long-term vision. It's not about betting, but about participating. Those who stay still waiting for the ideal scenario usually enter too late or never enter. And the cost of this wait is invisible in everyday life, but huge in the future. When talking about his own trajectory, Robert Kiyosaki makes it clear that there was no magic moment or sudden stroke of luck. The path was simple to understand, but difficult to execute. For many years, he chose to live below his own means, even when he could spend more. Not because he liked giving up comfort, but because he understood that each saved and well-invested dollar was buying future freedom. While many increased their standard of living as soon as income grew, he kept expenses controlled and directed the surplus to assets that could work for him. This initial discipline created something powerful over time: income that didn't depend directly on daily effort. Gradually, investments began to generate sufficient returns to cover basic expenses. This was the true milestone of independence. It was no longer about how much he could earn working, but about how much capital was capable of producing on its own. From this point, work stopped being an obligation and became a choice. Financial freedom didn't arrive all at once, but became inevitable because the process was respected. Patience, consistency, and repeated decisions over the years made more difference than any complex strategy. Those who observe this path realize that the secret is not in doing something extraordinary, but in doing the essential consistently, without interrupting capital growth. There is a phase of financial life that almost nobody likes to show, because it doesn't earn applause, likes, or immediate recognition. It's the phase of silence. You continue working, saving, investing, and saying no to things you'd like to do now, but that could compromise the future. On the outside, it seems like nothing is happening. On the inside, everything is being built. Robert Kiyosaki always taught that this is one of the most important and, at the same time, most misunderstood stages of the financial journey. During this period, you learn not to depend on others' validation. There is nobody praising your choices because they're not visible. You're not flaunting results, you're creating foundation. While many confuse success with appearance, you're focused on structure. It's like the root of a tree. It grows downward, invisible, before any leaf appears. Those who ignore this stage end up with a weak tree that falls at the first strong wind. Silence also protects. When you don't announce plans, you don't need to defend yourself from others' opinions. You don't need to explain why you're investing instead of spending, nor justify why you chose a slower path. This silence creates clarity. You start listening less to external noise and more to your own strategy. It's at this moment that discipline stops being effort and starts becoming identity. Over time, something curious happens. The people who didn't notice your choices before start noticing the results. But when this happens, the most important thing has already been conquered: financial maturity. Money starts to grow, but your tranquility grows first. And it's exactly this that differentiates those who truly build wealth from those who just chase money. Those who understand the value of silence learn that not all progress needs to be seen to be real. True financial discipline doesn't appear in moments of excitement, nor when everything is going well. It appears on ordinary days, when nobody is watching your decisions. It's easy to talk about focus and planning when money comes in, when investments go up, or when motivation is high. The real challenge begins when the day is ordinary. The salary hits the account, and you need to decide what to do with it without applause, without witnesses, and without immediate guarantees. Robert Kiyosaki always emphasized that most people don't lose money from lack of knowledge, but from lack of self-control. Discipline is not in doing something extraordinary once, but in repeating the basics correctly hundreds of times. Saving part of income every month. Investing even when you feel like spending. Maintaining the plan even when a tempting opportunity arises. These decisions seem small in isolation, but they are what build or destroy financial future. When nobody is watching, the internal voice that tries to negotiate emerges. Just this once. I deserve it. Next month I'll make up for it. It's in this silent dialogue that the game is won or lost. Those who build wealth learn not to argue with this voice. They create simple rules and follow them, regardless of mood or circumstances. Discipline stops being a constant effort and becomes an automatic habit. Over time, this posture generates something more valuable than money: self-confidence. You come to know that you can count on your own decisions. This security reduces anxiety, prevents impulses, and strengthens the patience necessary for compound interest to act. Those who master discipline in silence build results that sooner or later speak for themselves. Many people confuse patience with standing still, waiting for something to happen by luck or by an ideal moment that never comes. But financial patience is exactly the opposite of that. Robert Kiyosaki always taught that being patient doesn't mean not acting, it means acting correctly and then not interfering. It's continuing to make contributions, maintaining the plan, and respecting time, even when anxiety asks for movement. There is a natural discomfort in seeing money grow slowly. The human mind likes action, quick responses, a sense of control. That's why so many people touch investments unnecessarily, change strategies all the time, or abandon a solid plan because of a bad phase. This restlessness destroys more wealth than any external crisis. Patience requires emotional maturity to accept that not all progress is visible in the short term. Acting with patience means understanding that time is part of the strategy, not an obstacle. Each month in which you remain consistent, even without great apparent results, you're accumulating something invisible: foundation. When growth finally accelerates, it seems like it happened suddenly. But in reality, it was prepared during years of silent consistency. Those who learn to be patient stop seeking emotion in money. The focus stops being on getting the next move right and becomes staying in the game. This posture reduces mistakes, decreases stress, and increases the chances of reaching financial freedom. In the end, patience doesn't delay success, it makes it inevitable. Many people think confidence comes before action, but with money it happens the opposite. Financial self-confidence is not born from motivational phrases, nor from impulsive decisions. Robert Kiyosaki always explained that it is built gradually, through small, correct choices repeated over time. Each month you invest with discipline, each expense you avoid through awareness, each debt you reduce. All of this strengthens something internal that doesn't depend on others' opinions. At the beginning, insecurity is natural. You question whether you're doing it right, whether you're not missing opportunities, whether the effort is worth it. But over time, these doubts diminish. Not because the path becomes easier, but because you start trusting the process. This confidence is not loud, it's silent and firm. You stop reacting to every news item, every opinion, every financial trend that appears. This self-confidence changes how you make decisions. Instead of acting out of fear or haste, you act with clarity. You don't need to prove anything to anyone. You don't need to chase immediate results. You're building something solid, and this brings tranquility. Those who develop this internal security become less vulnerable to emotional errors, which are the biggest enemies of wealth building. In the long run, this built confidence protects as much as money itself. It prevents hasty decisions in difficult moments and avoids excesses in good moments. This is how growth stops being fragile and becomes consistent. Before money truly changes, something needs to change within you. There is a silent moment in the financial journey when the way of thinking begins to transform. You stop asking yourself only how much you earn per month and start asking yourself how much of your money works for you. Robert Kiyosaki always taught that this mental shift happens long before financial freedom appears in the bank statement. At this point, you stop seeing money only as something to spend or save and start seeing it as a tool. Each financial decision begins to be filtered through a simple question. Does this bring me closer to or further from independence? This change seems small, but it redefines everything. Purchases stop being impulses and become choices. Time stops being something to fill and becomes something to protect. When the game changes from within, anxiety decreases. You understand that you don't need to win today nor tomorrow. You just need to keep moving forward in the right direction. The focus shifts from comparison with others to personal consistency. Haste loses force because now there is a plan. And when there is a plan, external noise loses importance. This internal transformation creates an enormous advantage. While many are still stuck on monthly income, you start thinking about assets, about growth, about the long term. Even if the numbers aren't big yet, the mentality has already changed. And when the mind changes first, the financial result tends to follow sooner or later. Many people believe that getting rich depends on having a great idea, a special talent, or being in the right place at the right time. But in practice, most financial success stories have something much simpler in common: consistency. Robert Kiyosaki always reinforced that it's not the spectacular movement that changes life, but the decision to continue even when the process seems slow, repetitive, and emotionless. Consistency means making contributions even when the market is boring, when there's neither euphoria nor panic. It means maintaining the plan when results aren't impressive yet. It's continuing to invest in good months and especially in bad months. Those who depend on motivation or luck end up stopping midway. Those who depend on habit get through difficult phases without noticing, because they've already transformed the process into routine. Over time, this repetition creates a powerful effect. Small actions done every month accumulate, just like compound interest. For those looking from outside, it seems like growth happened suddenly. For those who lived the process, they know that each result is the fruit of hundreds of simple decisions made correctly over the years. Consistency builds a type of advantage that doesn't attract attention at first, but becomes almost impossible to achieve later. In the end, talent can accelerate, luck can help, but only consistency guarantees that the path continues. Those who understand this stop looking for the next big move and start respecting the basics done well. And it's exactly there that wealth stops being a distant desire and starts becoming a natural consequence. After understanding all this, one thing is clear: building wealth is not about genius, luck, or spectacular moves. It's about respecting the process. For a long time, the path requires brute force, discipline, and difficult choices. It's the phase when you work, save, invest, and feel that the effort is greater than the reward. Most give up exactly there because they confuse slowness with failure. But those who get through this stage arrive at a different point. When capital reaches maturity, the person's role changes. It's no longer about chasing after each dollar, but about having enough patience not to interfere with growth. Below a certain level of wealth, the focus needs to be action, control, and consistency. Above this level, the focus becomes calm, long-term vision, and respect for compound interest. True wealth doesn't arrive loudly. It's built in silence, with simple decisions repeated for long enough. Those who understand this game stop looking for shortcuts, ignore comparisons, and learn to trust time. And time, when well used, becomes the greatest financial ally that someone can have. If this message made sense to you, if at some point in this story you recognized yourself, then like this video and subscribe to the channel. This shows that you've decided to continue learning, growing, and building something bigger. And write here in the comments: I respect compound interest. This is the first public commitment to your financial future.